Okay, so we're looking at IFRS 5 on non-current asset held for sale. So from the name, non-current assets that is held for sale. Now, this is not the complete name of this standard. It's actually non-current asset held for sale and discontinued operations. So there are two different things that we are going to look at. So we'll look at non-current asset held for sale. Thereafter, we'll look at discontinued operations, all addressed by the same standard. And so let's look at non-current asset held for sale first. Now, from the name alone, you will see that this majorly would address non-current assets like PPE, like intangible assets, like investment property, like financial assets, which are non-current assets, right? So these are non-current assets. Though the focus of this IFRS 5, the type of non-current assets it's looking at majorly is around PPE, majorly around PPE, and some aspect of intangible asset also. But the point here is this: when you have non-current assets, the idea is that you want to use it within your company, either for production, either for distribution, either for rentals, or what have you, whatever it is you want to use it for, in as much as it will earn benefit for the organization for more than 1 year, then it becomes a non-current asset. However, you see, what this standard is actually looking at, okay, so sorry, can you still see my screen very clearly?
Yes, sir, we can.
Okay. So what this standard is looking at is majorly if you have a non-current asset that initially your intention was that you want to use it within your company for production or for supplies or for rentals. That's your intention. If at the end of the year or during the year that intention changes from using it for those purposes like for production or supply within your entity, and the intention now change to that you want to sell these non-current assets. If that intention changes, then that asset might be classified to a non-current asset held for sale. So that means we won't put it as it was before, whether it was a PPE before, it will no longer be a PPE. Now it will now be a non-current asset held for sale. However, before you can classify a non-current asset as held for sale, it has to meet certain conditions. There are two criteria that must be met before you can classify a non-current asset as held for sale. And the first condition is that the asset must be available for immediate sale in its present condition. The asset must be available for immediate sale in its present condition, and the sale of the asset must be highly probable. So the point we are making here is this: if you have a non-current asset and your intention for that non-current asset changes so that you now want to sell it, meaning that the way you are going to make money from that asset is not from using it anymore, but from selling that asset, then will be able to classify it as held for sale if it meets two conditions. One is the asset must be available for immediate sale in its present condition, and the sale must be highly probable. Now, available for sale in its present condition means that if somebody should walk in today that he wants to buy the asset, you must be able to release it. You must not say, wait, I need to do something on the assets. Oh, quickly need to complete something. I need to, no, no. If he has to, if it's going to be that case, then that means you cannot classify it as held for sale. You will still continue to classify it as it were before, whether it was PP before or whatever. For you to classify it as held for sale, it must be available for immediate sale in its present condition. And two is that the sale must be highly probable. And when we say the sale must be highly probable, that means five things. It means five things. And the first thing is that the entity or management must be committed to the plan to sell the asset. You have to be extremely committed. Two, there must be an active program to locate a buyer. And the asset must be marketed at a price that is reasonable in relation to its fair value. And the sale must be expected to take place within 1 year. And it is unlikely that there will be changes in the plan to sell the assets. Okay, so I can have asked IFRS 5 severally, and whenever they ask it, they always ask you what are the conditions for classification of a non-current asset as held for sale. Or before you can classify a non-current asset as held for sale, what are the conditions that must be met? So you must be able to really tell them this. The sale must be available for immediate sale in present condition, and the sale must be highly probable. And the highly probable means these five things I've just mentioned. So you need to find a way to understand it. Now, one of the conditions that must be met, because all of these conditions must be available. If one of them is not met, then that means you cannot classify the asset as held for sale. You see, one of the conditions is that in my point four here, that the sale should be expected to take place within 1 year. That means that if your intention now is that you want to sell the asset, you don't want to use an asset anymore, and you then classify it as held for sale, that means you are only allowed to classify it as held for sale for 1 year. So if after 1 year you have made all effort, you can still not sell it, that means it will be reclassified back to whether PPE or whatever asset it were before, to be reclassified there. However, however, if you are still committed to sell, if you have made all efforts and you can demonstrate that the reason you are unable to sell is beyond your control, meaning that you are committed, you have tried to locate a buyer, you have marketed it, and the price you are marketing it is reasonable, and you don't even want to change your plan. So if you can demonstrate that, the standard says that after 1 year, you can still continue to classify it as held for sale, right? But the primary requirements, right? So that one is an exception, right? So that one will need more disclosures and all of that. But the primary requirement is that you can only classify an asset as held for sale just for 1 year, because it is expected that you sell it within 1 year. Okay, you would make sense out of that very soon. Because in fact, let me make the point now. Because ordinarily, this asset you want to sell now used to be a non-current asset. But now that you say you want to sell it, that means in your statement of financial position, you cannot put it as non-current asset anymore, because now you want to sell. So it will now be a current asset. And when you have current asset, it means that you are expected to realize the benefit from that asset within 1 year. So, which is why we expect that when you classify an asset as held for sale, you must sell the asset within 1 year. And that's one of the conditions. Okay. And it's also possible that an entity might want to sell a group of assets at the same time, right? So the reason why I'm bringing that up is just I just want you to be familiar with a term called disposal group, right? It's common in IFRS 5 that instead of selling a singular asset, you you plan to sell group of assets. Then you put that in your book as a disposal group, right? So when you see disposal group, it's really talking about group of assets that we want to sell, right? And again, it's not just about selling just an individual asset. What is it possible for an entity to sell an entire division, right? Maybe a segment of your company. Probably your company has different segments. They have a segment that is into education. They have a segment that is into fintech. They have a segment that is into manufacturing. So they could plan to sell or divest one of those segments. Okay. So if that's the case, that would not be a disposal group. Then that would qualify as a discontinued operations, right? And which is the next thing we'll look at when I'm done with this aspect. Okay, that's different. So disposal group has to be individual asset that we can separately identify, not a segment. Furthermore, is that we need to be able to distinguish between when we say an asset is held for sale and when the asset is abandoned. When the asset is abandoned. So abandoned is that you don't have a use for that asset yet, or maybe you have a better alternative. So you abandon the particular asset. So when you abandon it, it's different from held for sale. An asset that is abandoned will still qualify as as an asset as it were. If it is a PPE, it will still remain a PPE. You will still continue to depreciate it, you will still continue to whatever to that asset. So abandoned asset is very different from an asset that is held for sale. So far what I've actually mentioned is about how do you classify an asset as held for sale? And it's majorly when your intention has changed about the asset, that what you want to do with the asset now is that you want to sell it. And before that can happen, it has to meet five conditions, right? And those five conditions is that no, not even five, two, right? The asset must be available for immediate sale, and the sale must be highly probable. So we now broke down that sale must be highly probable into five, which I've listed down to you and which you can see on your screen here. Now, so after you have classified an asset as held for sale, then you probably will have to um, know how much do you keep the asset in your books. I'm already going to measurements, right? I'll still come back to this question, right? So I'm going to measurement here. So if you classify an asset as held for sale, then at how much do you keep it in your books? So let's say you have a plant that you want to sell, a plan that you were using before. Now your plan has changed on the plant that your intention now is to sell it. That's what you want to do with the plant. So if the plant in your books was 5 million before, when it was PP as planned, now that your intention is that you want to sell these assets, then it doesn't become, it will still continue to be PPE again. You would classify it as non-coin or PPE held for sale. That is how you put it in your books. PPE held for sale. Now, it was 5 million in your books. Will it continue to be 5 million now that you have classified as held for sale? The standard said no, that you measure it at the lower of its carrying amount and its net realizable value. That is fair value less cost to sell. Okay, so it makes sense because now that you want to sell it, then the relevant measurement basis should be the fair value, right? So if you are going to incur any cost to sell, you remove that, then we'll have net realizable value. So the measurement of a non-current asset held for sale is the lower of the carrying amount of that asset and its net realizable value. However, so I want you to picture this. If a plant that you now want to sell, the carrying amount, that is the value at which it was in your books before, if it was, let's say, 5 million, let's say it was 5 million, and now that you want to sell it, now that you want to sell it, you now got the selling price. You discover that the selling price of this asset is, let's say, 6 million. Let's say the selling price is going to be 6 million. So that means that at what amount would you continue to put this asset in your books? No brainer is going to continue to be 5 million, and that's it. So you will not need to do anything since the 5 million is the lower. However, if the carrying amount is 5 million and the net realizable value happens to be 4 million, that means that the new value at which you measure the asset is going to be 4 million. That means that you have to adjust the figure on the books from 5 million to 4 million. And whenever we have to adjust figures on the books, that means we will need to pass double entry, right? So in this case now, since you are reducing or decreasing the value of the assets, you are definitely going to credit the asset. And do you know what you will debit? Impairment loss. You debit an impairment loss. So for IFRS 5, whenever the fair value is lower, that means you need to recognize an impairment loss. That reduction in the value of the asset. IFRS 5 call that impairment loss. The last online class we had was IS 36, and that was on impairment loss. You will see that the way we calculated the impairment loss in IS 36 is different from the impairment loss IFRS 5 is bringing now, because for IAS 36, impairment loss is comparing recoverable amount and carrying amount. And recoverable amount is the higher between value in use and net realizable value. So here is quite different. Here is an exception to that. Here, impairment loss is simply comparing carrying amount and fair value less cost to sell. So let's focus on what we have today. What we have today is this. Whenever the fair value less cost to sell is lower than the value at which it was in your book before, like the example I gave you, the carrying amount was 5 million, the net realizable value is 4 million. You need to write down the value of the asset from 5 million to 4 million. That difference of 1 million, we said, is an impairment loss, and that will be recognized to your POL. You see, that's the major story around IFRS 5. So let's look at these questions I have on the screen to demonstrate classification and measurement. Then I will show you finally how you present a non-current asset held for sale, which I've already told you that you now present it as a current asset. But I will show you a demo of a statement of financial position to see where it will now be. Okay, so let's look at this question. It says that on 1st January, 1st December 2013, a company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. The company does not intend to discontinue the operations currently carried out in the facility. At 31st December 2013, there is a backlog of uncompleted customer orders. Okay. The company will not be able to transfer the facility to the buyer until it ceases to operate the facility and has eliminated the backlog of uncompleted customer orders. This is not expected to occur until May 2014 required. Can the manufacturing facility be classified as held for sale? Okay, at this date, December 2013. Okay, so the key point here is this. This company really wants to sell this manufacturing facility. So let's just take this as an asset, manufacturing facility. They have found a buyer, and the people are ready, okay, to buy the asset. But when the people want to come and buy at December, they say they have backlog of uncompleted customer orders. That is, they still need the facility. They still want to use it. So, and if you remember, before you can classify a non-current asset as held for sale, it must be available for sale in its present condition. This asset, this manufacturing facility is not available for sale in its present condition. And for that reason, we cannot classify it as held for sale. We cannot classify it as held for sale because as at December, which is the year end, they still have uncompleted customer order. So that is, and for that reason, it will not meet the, the condition for classification. Okay. So that shows that if you meet the condition, because this guy will meet the asset will only be ready next year, May 2014. But our year end is 31st of December. Okay. So the best this company can do is to disclose it, is to disclose so that at least user will know that they have intention of selling these assets. Now that's the best they can do. But before you can classify it, it must be ready at that year end. If it's not ready, there's nothing we can do. Okay, I hope that is clear. This one that everybody is very silent today. Okay, it's a very straightforward standard, anyways. Okay, the next one. May Limited had the following assets at 31st March 2014. Um, a property that is offered for sale for 10 million naira during June 2013. Okay, so they had an asset, they had the following assets in March. Okay, so as at the previous year, they offered a property for sale for 10 million. Okay, so that shows that maybe their year end is March. Okay, so the market for this type of property has deteriorated, and at March, a buyer had not been found. Okay, they have not found a buyer. Management does not wish to reduce the price because it hopes that the market will improve. Okay. After 31st March 2014, the entity received an offer of 8 million. They received an offer of 8 million. Okay. And they want to sell it for 10 million. Okay. They received an offer for 8 million. And the property was eventually sold for 7 million in 2014. Remember, their year end is March 2014. So they didn't sell it until May before the financial statements were authorized for issue. Okay. So can the property be classified as held for sale? No, it cannot be classified as held for sale. And the reason is this one, the asset is available for immediate sale. The only thing why this one will not be classified as held for sale because they were unable to sell it. They were unable to sell it as at March. And that's not the only reason. The reason is that the price they are putting on it is not reasonable in relation to its current market price. You see, one of the conditions for a sale to be probable is that it must be marketed at a price that is reasonable in relation to its current market value. So if you look at it, they want to sell it for 10 million. And they told us that the market for this type of property has deteriorated. But management does not wish to reduce the price. So imagine, eventually, when they were even going to sell it in 2014, it was 7 million, they sold it. And somebody even gave them an offer in 2014 for 8 million. They said no, that they don't want to sell it. So the only reason why they did not sell is that they were marketing it at a price that is not reasonable. Okay, and that is why this one would not be classified as held for sale because of that one condition. because they were marketing it at a price that is unreasonable in relation to its current market price. Okay, so that's classification. I mean, there are past questions we will look at to also see that this is how I can ask when you want to ask classification. Another one is this one is under measurement 3.1. It says that an asset is reclassified as held for sale when its carrying amount is 10 million, its fair value less cost to sell is 7 million. How is the asset going to be measured? Okay, this is straightforward. Remember, it's at the lower of carrying amount and net realizable value. So we'll measure it at 7 million. So that's not out of place. Another one is they told us that another question, an asset is reclassified as held for sale when the carrying amount is 20 million. Okay, sorry, hold on. Yeah, so for this 3.1, we will measure the asset now at 7 million. But remember, it was 10 million in our books before. So that means we are writing what is in our books from 10 million to 7 million. So there's an adjustment here. So that means we'll credit the asset and debit impairment loss. So that means we are going to recognize an impairment loss of 3 million to POL. So that means in addition to recognizing 7 million now as the value of our asset held for sale, we also recognize an impairment loss of 3 million to POL for writing down the value of the asset from 10 million to 7 million. Okay, another one. An asset is reclassified as held for sale when its carrying amount is 20 million, its fair value less cost to sell is 24 million. Okay, so the lower here is 20 million, which is the carrying amount, which is the amount at which we had it in our books before. So this one doesn't need any adjustment. We just continue to have it at 20 million. So this is very straightforward. So the only instance where you will need adjustment is where the fair value is now lower. That means you need to write down the value of your asset. Okay, moving forward. Lastly is presentation. Presentation. So whenever we have an asset held for sale, if you can see my screen better now, you'll see that this is a sample statement of financial position I'm showing you right now. You'll see the one I painted in red. You'll see that it's under current assets. Under current assets. And it's even a separate line item so that they can see it separately. We have non-current asset held for sale. And if there is a corresponding liability relating to that asset, you put it also under current liability as liability held for sale. Okay, so that's how you present a non-current asset held for sale. You present it separately in your statement of financial position. And finally is disclosures. Disclosure. So I've seen them ask these disclosures for 7 marks. Sorry, for 3 or 2, for 3 marks or 4 marks. They ask for 3 disclosures for a non-current asset you have held for sale. Number one is that you give a description of the non-current asset. Number two is that why do you want to sell the asset? Explain the fact and circumstances. Why are you selling it? So if the asset belongs to a segment of your company, let us know the segment, and you also disclose the impairment loss. Because if you don't tell us that this impairment loss is as a result of because we reclassified it as held for sale, we might mistake it for the one of IS 36. So you need to disclose that. So those are the major disclosure requirements for IFRS 5, and that is everything for IFRS 5. Now, the on the flip side of IFRS 5 is something we call discontinued operations. And like I've explained before, the thin line between non-current asset held for sale and a discontinued operation is that non-current asset is non-current asset. It's like an individual asset or a group of assets, right? That you can identify separately, which you call the disposal group. But for discontinued operation, like we have here, it has to be a component of an entity. Okay, and that you either want to sell or you have held it for sale is a component. And a component of an entity is either a separate major line of business. Hello, class. Can you still hear me? Hello.
Yes, sir.
Okay, so sorry. Okay, good. So she asked a very good question that if you're unable to sell it and you had to take it back to what it was before, yeah. So that means that it's going to be at the value it was in your books before you classify it for sale. The depreciation you should have charged, that will be removed, right? So you have that figure on one side. Then you compare that, okay, at the date we say we are not even selling it again. If we're to, how much can we even sell it at that date? That is, you need to get, okay, what's the recoverable amount of, or the net realizable value of that asset at that date? So you compare those two figures, then you pick the lower of those two, and that's how you would actually work it out. So what I didn't tell you earlier is that when you reclassify as an asset has held for sale now, its depreciation will stop on that asset almost immediately. Okay, so I'm not sure if I've answered your question. Can I move forward?
Yes, you can.
Okay, so let's look at discontinued operations. Like I've told you, what makes.
I have a question too, sir.
Okay, please go ahead.
Sorry, now that we've probably adjust for the precision that was supposed to be charged earlier, I noticed that there will be the value will be like it's possible that the value is lesser. How do we bring it back? Like how do we introduce it back to our financial statement? Like okay, now debiting PPE, but this value now is less with the account still balance.
Yeah, that's a very good question. So the thing is this, you know, now when you reclassified it as held for sale, right? So it is either at the lower of the carrying amount, which is the figure it was before, or net realizable value, which is, yeah. So you pick the lower of the two. And when you do that, the value will not change. It's just going to be that as long as it is held for sale, which is of course 1 year. So when there's now change in intention that you have made effort you can't sell, okay, let me take it back. The standard also says that is also at the lower of the carrying amount and the net realizable value, right? But the only difference is that if the carrying amount you need to adjust for the depreciation you did not charge before. Okay. So if the lower was the carrying amount, all you just need to do is just to depreciate it for the previous year. Okay. All you just need to do is to depreciate it. That if what you were carrying it in your books when it was held for sale was that carrying amount, you just need to deduct depreciation because that is what it was in your books before, anyways. But if it was fair value less cost to sell, right? And you now need to bring it down again because the carrying amount, by the time you remove depreciation, it might become lower. You now need to bring it down again. All you just need to do is that that's synonymous to another level of a kind of impairment loss again. If you are doing that again, so that means you recognize another impairment loss. So the major idea is this: whatever the case is, right? What we are looking at is the lower, So the worst that can happen is that you recognize a further impairment loss, right? So that's the worst that can happen because you are looking at the lower. So whatever it was in your book when it was held for sale, now that you have now taken it back to its normal asset, so either PP or whatever. So whatever you will be taking it to is going to be lower because if the held for sale, if it is at net realizable value, if it's the lower now that you are not holding it for sale, that means you just continue to carry it at that. But if it is now the carrying amount and you now deduct depreciation that you have not charged for the past 1 year that is lower, just write it down further and recognizing an impairment loss further. That's the best or worst that can happen. Did I answer your question?
Yes, sir. Thank you, sir.
Okay. So, any further questions before I move on to discontinued operations?
You?
Hello? Yeah?
Yes, sir.
Yeah.
Good morning.
Good morning.
Sorry, sorry, can you throw more light on the measurement? My line was breaking then. I didn't hear you well.
Oh, okay. For like I mentioned before, though you will still listen to the recording ultimately. But like I mentioned before, held for sale, when you classify it as an asset as held for sale, you measure it at the lower of the carrying amount, which is the amount it was in your books, and its net realizable value. So they will give you in the question, you just pick the lower of the two. So if the net realizable value happen to be lower, that means you are going to bring it down the assets down to its net realizable value. So that means you would recognize an impairment loss of that amount you are writing down the asset to. So you credit the asset, debit impairment loss. We have looked at an example earlier on. And somebody asked that, okay, what if you now change your mind that you don't want to sell again? That means you need to reclassify it back to PPE again. So the standard also says that then you need to get the carrying amount that it was before, what the carrying amount before you held it for sale, which might even be what you have it if it were the lower. It might even be what it is in your books right now. It might. So if it's not, get it, remove the depreciation you should charge for that year, get a new amount, compare that with the net realizable value, which might be the value at which you are carrying it right now. So it's going to be either of those two. Okay, so you pick the lower. So ultimately, whatever it is that is the lower, if it's still the net realizable value that is now the lower, now like the day you say you are not selling it again, you just need to do a further impairment loss. But if it is the carrying amount that is lower, and after you have deducted your um depreciation for that year, you just continue to carry it at that amount. So we'll look at an example to really address that. But that's just what it is for held for sale. Okay, so let's run through this. This is a shorter one. So for discontinued operations, like I was trying to explain, this has to be a component of an entity. That is either a separate line of business or a geographical area of operation. That's what makes it discontinued. So if you have a segment of your company or another location of your company that's a separate line of business, and you now say you want to sell it, right? Then that one you will not call that held for sale. No, that is a discontinued operations. So that's huge. So when you have that, so at the end of the year, what the standard simply say to that is that it says that discontinued operations, you need to present it separately in your statement of profit or loss. So because this is a segment of your company, that means it will have its own profit, it will have its own revenue and expenses. So in your on the face of the account, that means you separate. Let me show you. Here is it. On your statement of profit or loss, you separate your statement into continuing operations. So you have continuing operations, you have the revenue and all of that for that, and you have discontinued operations. So in the notes, you now break down the revenue, cost of sales, and other expenses for that discontinued operation. But the point here is this: when you have a discontinued operation, you need to present it like this. You need to separate your statement of profit or loss into continuing and discontinued operations. So that means um, if that discontinued operation has assets and all of that, so that means in your statement of financial position, those assets you will now present all of them as held for sale, because this statement of profit or loss is just showing that okay, the revenue of that discontinued operation, the expenses and all of that. You have to separate it from continuing, because this is very important. It's very important, and this is why the standard says that when you close down operation, it will affect future prospect of the company. So it is important for users to know that you have plans to discontinue. So it will help users make informed decision, right? And that is what conceptual framework called predictive value, right? That's how user will be able to make predictions on the basis of your financial statement. And this one is saying that that discontinued operation that you are presenting in the statement of profit or loss, just present the post-tax profit or loss, meaning the profit for the year of that discontinued operation. Then in the notes, you now go and break it down, the revenue, the expenses, all of that. You would break, and the tax, you break all of them down in the notes, right? And if that discontinued operation or that segment that you want to sell, if it has assets, of course, that means you will sell those assets too. So your statement of financial position, they become held for sale. So you disclose all of that. So that one is not here. The disclosure requirement. So when you want to discontinue, the things you disclose is that one, you need to tell the user why. Just the same thing as for that held for sale. You need to tell us, describe that entity or that segment you want to sell. You need to tell us why do you want to sell it, right? And if there's any impairment loss on those assets you have held for sale, you need to also disclose it. So those are the disclosure that you need to make, and that is all about IFRS 5 on non-current assets held for sale. So there are series of past questions. Last diet, it was even there. Yeah, it was there last diet. It's something I can like to ask, and it's something you should definitely practice. So this is a past question now. So if you look at it, this question says IFRS 5 on non-current asset held for sale and discontinued operations, specify the accounting treatment for asset held for sale and disclosure of discontinued operations. Then also you should discuss the conditions that which must exist in order to classify a non-current asset as being held for sale, and explain the accounting treatment that apply when such classification is deemed appropriate. Like I've told you, is 7 marks. So these guys, they know what I'm saying. They're expecting 7 key points, right? So, and beyond that, they said discuss the conditions which must exist. And the condition is one, the asset must be available for sale in its present condition, available for immediate sale in its present condition, and the sale must be highly probable. And those ones are five. Management must be committed to the plan to sell. There must be an active program to locate a buyer. It must be marketed at a price that is reasonable in relation to its current market price. It must be sold within 1 year. There must not be a change in plan to sell. So that will give you almost 4 or 5 marks. You are now asked to explain the accounting treatment that apply when such classification is deemed appropriate. And the accounting treatment is that it is measured at the lower of the carrying amount and its net realizable value. And I told you that if the net realizable value is lower, the entity will recognize an impairment loss. And when an asset is held for sale, depreciation will cease on that asset. And that is it. That ends you your 7 marks. And the B part says that Whiskey Bottling Company PLC specializes in the production of alcoholic wine known as Blue Bull and soft drink called Whiskola. Okay. So that means they have two segments. Hence, the company operates two divisions. Okay, good. Blue Bull and Whiskola. Then I said, due to high cost of labor and shortage of raw materials for the production of the wine, the Blue Bull division has incurred significant operating losses. Okay. Management decided to close down the Blue Bull division and draw up plan to discontinue operations of the division. Okay, so they plan to close down this Blue Bull. I mean, this is a typical example of a discontinued operations. When I told that on February 1st, 2019, the board of directors of Whiskey Bottling Company approved and immediately announced the formal plan. Okay, the following figures are available for the current year ended 31st 2019 and 18. So they gave us for Blue Bull and Whiskola. So is this guy, Blue Bull, that they want to discontinue. They gave us all their figures here. So they now gave us some additional information. He said the following additional costs are directly related to the decision to discontinue. So because they want to discontinue, they'll pay severance pay, which was incurred within this period. They also told us that a proper evaluation of the recoverability of the assets in terms of IS 36 to the recognition of impairment loss of 9. Okay, so there was an impairment loss of 9.5 million, and they told us that which is included in other operating expenses above. So that means this 9.5 million, they are saying that it has been included in this other operating expenditure of 15 million. So that means this 9.5 million is there, is in this 15 million here. That's what they are saying here. So we're now told that required. He said, draft a statement of profit or loss of Whiskey Bottling Company, that is the entire company, okay, for the year ended March 31st, 2019, together with the comparative figures for the year 2018. Okay, and that's 10 marks. Good question. They also said the director of finance of Whiskey Bottling Company stated that there should be some additional disclosures about the discontinued operations which should be shown in notes to the financial statements. Identify three of such disclosures for 3 marks. Okay, this is also sweet. So let me start with this. These three disclosures, I told us you need to do a description of the discontinued operation. You need to state the fact and circumstances surrounding why you want to discontinue. You need to also disclose the impairment loss on the measurement of the assets of that discontinued operations. And of course, from what I can see here also, any additional costs attributable to that discontinued operation or as a result of discontinuing the operation must also be disclosed for the user to be aware. Okay, so those are 4 points here. Okay, you have it in the note. The solution is there with you guys. If it's not in the one I sent you, I'll just send you this one. Okay. So now they say we should draft a statement. See, based on what I've explained to you before, all you just need to do is that for this company now, comprising of Blue Cola and Whisk Cola, right? So we need to separate their statements into continuing and discontinuing. From what I can see here, the only continuing operations will now be Whisk Cola, while Blue Bull will be separately presented as discontinuing operation. Let me show you. Let me show you what I'm saying. This is what I'm saying. So this is the statement of profit or loss here. This is the heading. This is where it actually started from. The name of the company, statement of profit or loss. So you see the way I've presented it. I had continuing operations. You see, this revenue, cost of sales, gross profit that you are seeing here for 2019 and 2018 are that of Whiskola only. If you look at it, Whiskola revenue is 1570 here. Here too, I just put 1570, and this is the comparative figure. The cost of sales, the distribution cost, the admin, everything. I just copied it. So it's a very simple question. I just copied it from the question down here and I just presented it properly because yeah, they just gave me all of those figures. But yeah, I remove my cost of sales, I put gross profits, I remove my distribution, admin, operating, I put profit before tax as the result. Then I remove my income tax, I have profit for the period. Yeah. So after that one, I'll now have my discontinued operations. And this figure here is the profit after tax of that discontinued operation. I now put workings. I now go to my workings. So I started for the discontinued operation. First, the revenue. And this one too, I just go there and dub. For the revenue for Blue Bull 2019 is 235. Yeah, 235. The cost of sales 175. I'm just dubbing from the question. Just that I now present it properly in a statement of profit or loss format. So I have my gross profit. I have this. I deducted my distribution cost. I have this. My admin. Then other operating expenses. The only thing is what I did that you need to work on is this. These operating expenses. Remember, they told us that uh, an impairment loss of 9.5 million is included in other operating expenses. And the standard requires that this has to be separately presented. You need to disclose it separately, right? So, which is why I had to remove that 9.5 million impairment loss from this 15 million. So I had 5.5 million left. This 10 million is just as it is for 2018. Nothing has changed. So this 9.5 million that I removed from here, I now presented it separately here. Impairment loss, 9.5 million. Not only that, the severance pay of 42.5 million that they told us here, this 42.5 million, that one also I presented it separately here. Then, and that is it. I have my profit before tax. I deducted my tax. So this tax, this was a loss, but this will be a tax credit, and this is why I have it here. They put tax credit in brackets here, 3,000. So meaning I'm not paying tax. In fact, they are going to refund me. So, which is why, like, it's just like a loss relief. So, which is why, this 3,000 reduced my loss from 52,000 to 49,000 because it's not additional tax. For but 2018, where the guys still made profit, you will see that yeah, the tax was deducted, then 3.5, and that's it for that for 10 marks. So that's a straightforward one. Let's look at another question. This one says that the or do you have a question? Do anybody have a question? Okay, nobody.
Okay, sorry, sir. This
Sorry,
is
I have a question.
Okay, go ahead, please. One after the other.
Sorry, sir. In exam condition, are they going to give a separate, maybe they want to discontinue a particular line of business, so they will give all the details of revenue and expenses, and that's what um will be adding after the first I don't know how to put it.
Yes, now after the
Like
continuing
just run it.
operations.
Okay, I will just write discontinued, and I started from beginning to the end, from revenue less cost of sale. Is that what you mean?
Oh yes, 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 yes. Like this one I just solved now is a past question. They gave us all the figures. And what I just did is for Wiscola, I put on top continuing operations. All the figure they gave me, I put it there till the profit. Then I now have discontinued operation. If you don't want to go and show it in workings, right? This discontinued operation, you can put the revenue, whatever, below like this, right? But it's just for organization. Just put discontinued operation and now go to workings and work the revenue, cost of sales, and all of that. And all of the figures will be given to you in the question. So you just pick them and organize it properly. The only thing you just need to note is that any other cost, additional cost, as a result of that discontinuation must be presented separately, which is why the impairment loss that they told me was inside this. They told me that 9.5 million is inside the other operating expenses of 15 million, which is why I came to remove it from here. I removed it. I now presented it separately here. And this severance pay too, I presented it separately here. That's just the only thing. Otherwise, I'll give you everything. And this is not the first time they're asking this question. They have asked it like severally, and this is how they always ask it for discontinuing operations.
Thank
Yeah. Any other question?
Yes, sir.
Yeah, I'm with you. Go ahead.
Yeah, I really want to know if when a segment or a location of business is being sold, then what happens to the activity already involved in that segment?
Ah, I'm struggling to hear you.
Okay, can you hear me, sir?
Yeah.
What I wanted to actually ask is if a segment of a business or a segment or a location of a business is sold, then what happens to the activity already involved in that segment?
Oh, okay, okay, okay. Like I told you, if I get you correctly, what I picked is that if a segment is discontinued, that what will happen to the liability of that segment, right? So just like I've told you, this in the statement of profit or loss, these are just the revenue and expenses of that segment that has been discontinued that we presented separately. In the statement of financial position, okay, the statement of financial position, that assets of that segment will be presented under current assets as non-current asset held for sale. The liability of that segment will be presented under current liability as non-current liability held for sale. Okay. And of course, you know that it becomes the liability of the group. They will settle it now. Just that is for us, we need to present them properly.
Thank you.
Except if the person that wants to buy the entire segment is buying everything. But for presentation that we are concerned about now, you present the asset as non-current asset held for sale. You present the liability as non-current asset held for sale. So, however they want to close the deal is now left to them. Any other question? Okay, let's look at this question. This question says that the management of Tolo Tolo are considering the sale of an item of plant and machinery. Okay. The machine was acquired a few years ago and will be replaced by a new modern machine, which is currently being manufactured. The management of Tolo Tolo intends to sell the machine as soon as it takes delivery of the new one, which is expected to be after the end. Management is currently actively seeking a buyer for the existing machine, while an appointment has been booked with a service center to refurbish the machine prior to its sale. Okay, if you were following me, this one is just that they want to buy a new machine, then the one they were using before they want to sell, and they say that they cannot sell it until they take delivery of the new one. Even from here, sef, I already know that if they are going to ask us, should they classify it as held for sale? I already know the answer there. They will not classify it as held for sale because it's not available for sale in its immediate condition. It's not available for immediate sale because they are still waiting to take delivery of the new one before they can release. No, no. It must be available for immediate sale in its present condition, even before finishing reading this one. We already know the answer. But let's read on. They now say that the machine is carried in the books at 2.45 million, of course, which will be the carrying amount, I guess. Okay, they say that which approximates to its fair value. Okay, but that's how much, yeah, that means the fair value and the carrying amount are almost the same figure. Okay. They now said the current machine is being marketed to potential buyer at 5 million. Yeah. So something that the fair value is 2.45. These guys are marketing it for 5 million. Management has classified the machine as held for sale under IFRS 5 and discontinued operations. And I said a new product is currently being developed internally by the technology team at Tolo Tolo. Okay, ignore this one. This one is another question. This A part is addressing the first paragraph. This B part of this question is addressing to this second one. So then I said discuss whether the item of plant and machinery can be classified as held for sale. Okay, so this question was asked around 2018. For you to get 7 marks here, first you need to state the conditions first, that before an asset can be classified as held for sale, it must be available for sale. Okay, so the first thing is you need to state the conditions first. When you state the conditions, then the next thing will be you now analyze the scenario. For me, I'm seeing two things here. For me, these guys are marketing it, and they are marketing it at a price that is not reasonable in relation to its current market price. The fair value is 2.45 million, but they are making it at 5 million. Another thing is that the asset is not available for sale in its present condition because they are waiting to take delivery before they can release it. Okay, so I'll get 7 marks from there. This second paragraph is another standard. They said a new product is currently being developed internally by the technology team at Tolutolo. The product is expected to be completed in 4 years with users acceptance testing finalized. The management of Tolutolo are of the view that production phase will be in 5 years' time. We now say that a significant amount has been incurred in the current year on development of the new product by the technology team. Advise how the amount incurred should be treated in the year-end financial statement. Who can tell me in this class how we're going to address this? Where's everybody? Everybody's still here.
Yes, sir. Well, yes, sir.
Has this online class ended?
Yes, sir.
Well, yes, sir.
Oh, okay. Okay.
This Joe, I don't, I don't know. I just want to ask something. Can you hear me?
Yes, can hear you. Your line is echoing, John. So I think you should just mute.
Same
So
thing.
let me just continue.
Okay.
Okay, so that you can save time. Ah, I think please mute. There- There's somebody re-echoing my voice. Okay, thank you very much. Okay, so this one is talking about IS 38. Okay, remember, yeah, for skill students, IS 38 because they are developing it internally. So this is an internally generated intangible asset, and before you can capitalize it, as development costs. That we call research and development. Research and development. And research expense would be expensed, or research cost would be expensed, while development cost would be capitalized. And before you can capitalize development cost, it must meet um, the six pirate conditions. If you remember, I shorten it as pirate, right? So it must be probable that there will be an inflow of economic benefit. The entity must have an intention to complete and use the assets. Resources must be available to complete it. It must have the ability to to sell this product, and it must be technically feasible to complete, and the expenses must be identified. So that has to be stated clearly that if those conditions are met, then the cost should be should be the development cost in these assets should be expensed. Otherwise, Sorry, if these conditions are met, then the development cost will be capitalized. Otherwise, all expense incurred on developing this technology team should be expensed. And that's how you're going to answer this based on the information we have here for 7 marks. So for professional students, we'll still revise IS 38 later. Okay, so this question is the last one, and I won't. This is the only question left. I don't want to do this because it's just the same thing as that first one I did. Because they gave us the same question, just the same thing, the same thing. So I won't do this. I think you should go and attempt this yourself because it's the same thing. They say we should draft a statement of profit or loss and all of that. So just like I've done that first one, you will separate the one that they discontinued from the continuing like that. And this first part, which is saying the conditions that must be met for a non-current asset to be classified as held for sale and explain the accounting treatment. It's just the same thing. It's just they just this is profession. That first one we did was skills. This is professional. So the question they asked in professional in May, they came to ask it in skills in November. The same thing. Nothing is different here. Okay, so and this brings us to the end of IFRS 5, non-current asset held for sale. Any question?
Hi, Mr. Usu.
You are what?
Can you hear me?
Oh yes, I can hear you.
Okay, hi. So just sorry to take you back to that Tolu question. The B part of the question that speaks to development cost and the R&D cost. So you said if it meets the six criteria, then we should capitalize,
Yes.
right?
Yes, yes.
So I was just thinking about its amortization, like when the production. Just to be clear, do we now amortize this cost
No, no.
when the production phase begins?
No, 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 no. You don't. You don't amortize it. So, if you remember, amortization or depreciation commence when the asset is available for use. When it is ready for use, that is when depreciation or amortization starts. So this one is still in production, right? So we cannot start amortizing it until it is completed. So you will just be capitalizing it after it has met that condition, be capitalizing until you complete it. So when you complete it, then you start amortizing it.
All right, thank you.
You're welcome. Any other
Yes, hi.
question? Yeah, I'm with you. Go ahead.
Oh, sorry, sir. I want to find out whether these examples that we are doing is in our study pack.
Oh yes, they are there, and I've even forwarded the soft copy to you again.
Okay.
But they're actually in our study pack. Just that there's no solution there. Any other one? Okay. So let's move to IAS 40. But can we please take 5 minute break?
Well,
All right.
Okay, sir.
It
You don't have to leave. Oh, it's
can
don't go anywhere. Oh.